So a lot of retail, especially the narrative, what we've seen, there's a lot of undisciplined investors that really are asking the wrong questions. I always see is like from the conversations that we've been having with a lot of our institutional investors, I always hear the same thing. Then usually they ask the same question: What is my downside? Like how can I protect my risk and not just look at the returns? And every time when I have conversations with retail investors, it's always like, well, what's my return? What am I going to get? That's really the wrong question to ask. It's great to look at a return profile, but for me, if you're going to look at it from a place of like a real investor, an institutional investor, you have to ask, how can I protect my downside? Because at the end of the day, yeah, you can target a 20% return, but what if you don't? Like what are the mechanisms that you're putting in place for you to protect your capital? Because if you're all you're thinking is about the returns, you might as well go gamble. And this is not gambling.
All right, guys, welcome to another episode of The Report. Today, I got someone special. I actually got two folks special in town, but one of them is very special because he, along with his brother, used to be one of my original mentors when I first got in the real estate game. But I got my man, Johnny Azar, and Francisco Herrera. Gentlemen, welcome to the show.
Thank you.
Excited to be here.
Thanks for having us, man.
Pumped to have you. You guys going to be at the holiday event this weekend. I cannot wait to celebrate and catch up with you guys, man. It's going to be a great time out there on the water. I know a lot of our investors are going to be there. And I always say this game is about being in the right rooms. It's also about being in the right boats. But my first question to you guys is, why are so many multifamily deals, apartment deals, going back to the bank? And why are there so many failed apartment deals here in the last 12 to 18 months?
Yeah, I mean, I can kick us off, and Francisco will definitely jump in on that one. He can bring probably the biggest chunk of the answer for that. I think a lot of it is starting with the buy, obviously. I mean, if you remember back when we were working together years and years ago, first thing we said is you make the deal happen on the buy. And if you can't make the deal happen on the buy, there's no hoping that it's going to work in 3 or 4 or 5 years. Hope is not a method. So you got to make sure that your numbers are tight right in the beginning and not hope that numbers are going to improve at some point or another. If you set a strategy right and you buy your numbers are tight and your underwriting is right, then the deal is going to perform. And as long as you are under very, very much under being very conservative in your numbers. Francisco, you want to jump in?
Well, I'll go a little bit above and beyond that. Is euphoria will mask risk. And that's what we saw in 21 and 22. So where we're at today is essentially the chaos and the euphoric environment that we were in 21 and 22. As you know, especially right now, there's a big talk in AI, right? So everybody's trying to figure out, is this a bubble? And so usually the start of a bubble is where there's euphoria. And so what we saw in 21, 22 post-COVID was that euphoric environment where it was a complete anomaly. What you were used to going and looking at multi, you're putting in your LOI, you're bidding, right? It was more than like just one round of best and final. There was markets have gone down to like 0% interest. So what happened is that cap rates compressed. And I'm pretty sure your audience is educated on this, but when you compress the cap rate, higher valuations, well, what's happening is everyone's saying, we're okay with that kind of risk. Let's go ahead and just start buying everything and anything. Doesn't matter the basis, as you mentioned, but that premium just made it so difficult for us to actually buy. But what happened is that everybody who was buying at high premiums also had to put in risky debt. We don't play in the risky debt. And by risky debt, what I mean is that you couldn't pencil in a deal because you're paying such high premiums. So you can't put on long-term fixed rate debt. So what are they doing? They're putting on bridge debt. They're being a little bit more risky. Now, what's happening there is the only way that you can make a deal work at that point is you have to get bailed out by rent growth. And we saw that, right? Double-digit rent growth. Everybody was like, this is normal. And for us, I mean, a conservative rent growth projection, usually anywhere between 2 to 3%. You were talking about operators getting deals saying, I can make this work because I'm getting 10, 12, 15% in rent growth.
Well, we saw that in Phoenix. Phoenix led the nation for about 7, 8 years straight, 9, 10% annualized rent growth. And a lot of those operators out there buying deals in 2020 and 2021 were assuming 10% rent growth would last forever. I was out in Scottsdale a couple times this past month. There's a lot of new construction multifamily deals in Scottsdale right now that are like 30% leased up, 20% leased up. they can't lease his buildings up, and they're throwing all sorts of concessions, dropping the rents, and they can't rent them out. They got a big problem out there in Phoenix right now because of it. And so, to go to your point, yeah, like the rent growth, you got to stay conservative. And one thing that you and Tony, your brother Tony, always told me. And by the way, for the listeners out here, John and his brother Tony, when I met them, they had transacted 8,000 apartment units out of the Southeast, out of Charlotte. They had been in the game for quite some time. And when we started working with you guys owned about 5,000 units at the time. We ended up doing a couple deals together. Timber Creek Apartments, 145 unit townhomes, garden style community in Greensboro. The Arbors, townhome style community, 150 units out there in Greensboro as well, which we still own today. But that was my first taste of what it was like to get into the larger deals, raise money, underwrite, all that sort of stuff. But one thing that always stuck with me, and I'm glad that you guys taught me this, because I still stick to these principles today, and it's kept me out of a lot of trouble, is always underwriting conservatively, always sticking to conservative assumptions, using a very conservative exit cap rate when you underwrite these deals. And so by doing so, it's kept me out of chasing bad deals, and it's kept me out of a lot of trouble in a time where a lot of deals have gone back to the bank, especially on the multifamily side, which is interesting to see.
Yeah. No, that's the best.
Yeah. So for both you gentlemen, are you guys seeing, and we're going to talk about other asset classes too, because I know right now with Peak 15 Capital, you guys are investing in different asset classes, not just multifamily. But I'm curious, in the multifamily game, are you seeing a lot of these deals that had 5-year perm financing? These terms are coming due now. Are you seeing some of these operators where they're like in a position to where they have to let go of these assets for a discount? What are you guys seeing out there?
Oh yeah, I mean we're the floodgates have definitely opened off the books, as I would say.
Really?
You're not seeing them publicly, but there are a ton of private transactions of distressed assets right now.
Really?
Ton of distressed assets.
And so you're seeing deals hit your buy box of people like, hey, like these guys are in trouble. They're willing to
Oh
let it
yeah,
go
I
at
mean
this
we're
number.
doing those deals. I mean we're doing those deals, but a lot of those deals are not publicly announced. They're not publicly known. The lenders are wanting to keep them.
Well, they're doing it quietly,
they're doing it
because
quietly.
I mean,
Exactly.
there was so much in 21 and 22. Is going back to your first question, is like, how do these multifamily operators get to that level? Is that the banks also played a part on this? Is that they were also part of kind of like the whole euphoric environment. They loaded so much risk by putting so much on their balance sheet. Again, once you get a little bit of taste, and you're seeing kind of like the market almost like, hey, this
I mean,
is
it
once
takes
in a
two to
lifetime
tango. It
movie.
doesn't just the operator's not the only one
Yeah.
at fault here. The lenders were enabling
So
those operators.
everybody was making money, and so the lenders were just lending, right? And so now those lenders, I guess the theme has been for the last year or so, probably a little bit more now, is like, let's extend and pretend, right? I think what we were anticipating is that last year, that's when banks should have been offloading, but they wanted to hold off a little bit more. Now we're still the end of 2025, and we're just barely starting to see them offloading that, what they should have done last year, right? And now they're selling assets at like 70 cents on the dollar, which they could have been made whole. They could have been made whole had they just done that last year, but too much of the extent to pretend, it's already way too long. And it's like, now they're in a situation where they're taking bigger hits, but they can't do that. They can't do that just off the bat. They do it quietly, because you start to now see multiple lenders offloading these billions of dollars of portfolios. It's going to cause chaos in the market. Everybody's going to be like, what's going on? You know what I mean? And
because these lenders are selling 78 cents on the dollar on their basis, on their lending basis, not on the deal basis. So you're basically getting the deal at 45 or 50 cents on the dollar based on the original market rate.
So why are the lenders, generally speaking, let's call it, most lenders are going to be lending about 65% LTV, maybe I'm just saying generally speaking. And you're saying they're lending a percentage of that 65%. Values have dropped that much?
Well, the problem is, so you just mentioned part of the problem. The problem is there was almost the perfect storm back then in 2022 and 23 or 21. The perfect storm is the values of the properties was overvalued. It was overblown, and the lenders were coming in and overextending the LTV. The leverage on that on what they were giving on the loans back then was 75, 80, 82. I mean, we've seen lenders push beyond 82, 83%. So when you're over leveraging an already expensive asset, and already too expensive assets, and then 3 years later, the market, goes down from goes down from underneath you, you're left with an overpriced asset with an over leveraged loan. So it's a perfect storm of like, crap. Now you got this asset that's like you can't make ends meet because you can't pay your loans. You can't do your debt payments.
Because we bought one deal in December of 23. Our bridge lender, who we have a good relationship with, funds a lot of our boutique hotel deals, came to me in November of 23, 40-room, newer construction deal up in Lake Chelan, Washington. Lake Chelan's never in our buy box. It's always been California coastal, but when a deal comes through a personal relationship, sometimes it's too good to pass up. So we closed December 23. They came to me and they said, hey, we got to get this off our books. We just took it back from the developer. We got to get it off our books by the end of the year. This is in November. And so they said we could sell it to you for a discount. They sold it to us for, they had a loan on that thing for about 65% of the appraised value. They sold it to us for probably 70% of what the original value was. And so we got a big discount, but they still made a little bit of money reselling it to us. They seller carried it for 2 years. And then now I'm in a position where I'm about to refi them out. Okay. And so anyhow, you're saying in this multifamily game, some of these lenders that they're not even able to sell it for the number they loaned for.
No.
Well, you have to get creative.
Yeah.
I mean, look, these
Because
lenders,
these assets have a lot of vacancy or the rent
No.
growth was
No,
has-
So
it's got nothing to
it's-
do with the asset. The asset
It's
is not
asset
broken.
stabilized.
The
It's just-
asset is not broken.
it's just
a
cap
lot of
rates have
times.
gone up.
It's the
It-
financing
Interest
that's
rates went
broken.
up.
It's the
DSCR
financing.
doesn't cover.
That's right.
Damn.
this is the theme. It's not an asset issue. It's a capital structure issue. It's the capital structures that are broken that is causing for these opportunities to now show up. You still have great quality assets and amazing MSAs. They're stabilized, but they overpaid so much that they can't cover their debt service. And two, their loan is maturing. But you're in an environment where they underwrote that they're going to get out in maybe like a 5 cap, but we're not even near that. The spread of what they paid for, and going back to what you said about overpaying, think about the spread. You're buying a property at a 4 cap, which is usually unheard of. I mean, here, maybe in California, of course, you can buy property at a 4 cap. But when you're in the Southeast, a 4 cap, maybe on a C-class asset, it's like once in a lifetime. If you're holding that asset and you're in that environment, sell it all day. You're never gonna.
Right.
That's money.
And that's what
Right?
we were seeing in 2021.
Yeah. So
Yeah.
then now we're in an environment, rates shot up so quickly, they went vertical, 500 basis points, right? So now those who thought, hey, everything's going to still stay low, we got low interest rates,
Is that how much the rates went up from like early 2022
500 basis
till
points.
to the last
Yeah.
few years? It went up
500.
500
500 basis
basis
points, and it just went vertical.
Boy.
We can.
How many rate
here's-
hikes was that?
Oh my God.
It was like it was more than a dozen.
Oh yeah.
It's more than that. It's probably 15 rate hikes, I think. I
My
don't know.
gosh.
A
Well,
lot of-
here's the thing: is that
That's crazy.
it's nuts.
the rate environment wasn't the issue. It was the velocity of the rate that it went up. That's what really is hurting real estate. Is the fact that, I mean, you've transacted in times where rates were like at 7%. It was never an issue. The fact is that it was at the velocity of how quickly they did. It just went 500 right off the bat when it was just at 0. And so everybody was thinking, oh, you know what, if we get a couple like basis points, if they go up, we'll be fine. No, but it just hikes so quickly. Now that we're in trouble.
So speaking of the rate environment, the Fed just announced a third consecutive rate cut yesterday, which is a total of 75 basis points of cuts to end the year. And then depending on who you talk to, we're going to see some more rate cuts next year. I was talking with one of my retail investors last night, and he's pretty connected. He was saying this guy Hassett, if Kevin Hassett becomes the Fed chair, because we know Jerome Powell's out May 15th. He said this guy Hassett, he's gonna cut the rates quick, and he's thinking if Hassett gets announced, Trump's gonna announce it potentially next week, and if this guy gets announced, he said he's betting on at least 150 basis points of cuts next year. That'd be pretty big.
that would be pretty big. I would think we're thinking at least going to be 100 next year.
Next year, you're
We're
confident on that.
definitely in a declining interest rate. I mean, I come from the DNA of my investing DNA comes from Tony.
Yeah.
So I'm gonna put my conservative hat on. I think we'll be anywhere between 4.25, 4.5 the next 3 years. But I mean, it's
On an all-in rate to buy multifamily.
yeah, exactly.
4.25 to 4.5.
Yeah, but I mean, it's just it's all talk. I mean, at the end of the day, I mean, of course, Trump wants to kind of push like, hey, we need rates to be cut. And look, whoever he puts in office, they're gonna have to listen to Trump at
Yeah.
the end of the day.
And so what do you think on the high side we'll see in rate cuts next year in terms of like total basis points?
I'd rather not even comment on that.
You think we could see 200?
That's pretty fast.
Yeah.
It's pretty fast. I don't think we'll
I mean,
get,
they raised it 500 pretty fast.
and that was their mistake. I don't think they will make the same mistake again, because you have to understand is like with cycles, they always blame everybody who's in real estate that kind of crashes the market. This time it wasn't the real estate operators, right? This time it was the Fed and how quickly they increase rates, and now that is what kind of made the distress right now in the capital structure.
Here's how I look at it. I mean, this year they've reduced so far 75 bips. So next year, if they want the economy to fast track itself a little bit more than this year, they're gonna have to outperform that. So that's where my 100 basis point came from. I'm like, if I think of like if they're trying to stay conservative but still outpace this year, it's gonna have to be close to like 100 basis point cut next year.
Yeah, absolutely. So one thing I remember about the cap rate environment in multifamily back in 2021 was A class, B class, C class. The cap rates were essentially on top of each other. And I remember we sold actually you PG'd this deal, 32 unit building with Sean, Mike, and myself. It was one of the first deals we ever bought. Cashed our 401ks out of the air traffic job, bought this, went to refi it into a Freddie loan. And I didn't even have the net worth at the time. So brought you in, and we got that refi done. Anyways, we ended up selling that deal 2 years later. We bought it for 1.1, sold it for 3.1. 32 unit C-class 1960s construction, had plumbing issues, and like we sold this thing for, I remember the deal next door was being sold. It was like a 200 unit property. I remember talking to the broker, and I was like, damn, like 100 something a door. And he was like, dude, I can get you the same thing if you want. He's like, I could just ask this buyer if they want to buy yours too. It's directly next door. And so I was like, fuck, we can get 100 a door. I'm like, all day. I think we paid like 31 a door. And so the buyer next door didn't end up buying it, but he ended up getting another offer. And sure enough, we ended up getting damn near 100 a door. And this is early 2022, right before the rates started going up. This guy bought it for 3.1. We had bought it 2 years later for 1.1. And we renovated just half the units. This thing had plumbing leaks the whole time we owned the asset. And this guy he syndicated the deal, raised money. And I'm just thinking, damn, I don't know what this guy's saying. I think he got a bridge loan on it. I have to look
Don't
the
tell
deal
me
up.
he
We
sold
should
it for
follow that.
$5.
I don't know. I need to look at the deal up on CoStar. I'd be curious to see like if this deal went back to the bank or what, because I'm like, there's no way that guy's in a good spot right now. But he paid a 3.7 cap rate on trailing 12 financials. And now I'm thinking like C-class deal coming out of 2021, a 3.7 cap rate, 1960s in a submarket in Indiana in the Midwest.
This
Like,
goes back to the
that's
narrative.
So
But
cringy.
that's-
That's so cringy.
But that's where dumb money was going.
I know.
There was definitely a wave of undisciplined investors in the market. And I think those are the ones that are now being shown, right? It's like the true strong operators. Those are the ones, the disciplined investors are going to stay in the game because they're long-term. So like you sold at the height of the market, I think.
Dude, we did a tenants in common. I took my proceeds. I 1031 individually into a really nice asset in Scottsdale, like a nice estate. And I just parked my money. I'm going to own that asset for a long time, but that's cash flow and Airbnb for me. It's a really, really nice luxury thing. And I'm good with that.
Yeah.
Yeah.
I'll gladly take those chips off the table. We got out, we got out at the right time.
No, it
Oh,
was
yeah.
perfect. No, and you sold at the right time.
Yeah.
And that's the thing. It's like I would follow that deal just to see where it's at, because I'm gonna tell you a quick little story. I mean, you have to be disciplined in this game. There's and again, learned that a lot from Tony. A lot of my DNA comes from him, and it's always looking
My
at
DNA
your
literally comes with him. Like,
yeah,
I know, literally.
my investing DNA. But
Yeah.
one thing that always stuck with me is that besides just being conservative, with investing is, oh gosh, I just lost my train of thought with what you just
Sorry.
said.
You saying conservative investing, staying disciplined.
Staying disciplined. Oh gosh,
Lost track of that deal.
Well, as it comes
Yeah.
back to you,
It'll come back. It'll
answer
come
this
back.
question. So cap rates were on top of each other back then, essentially A, B, C. And so a lot of people were like, oh, let me just buy the A-class stuff, right? Because all trading at the same cap rate. But 2 years ago, I went to go interview the apartment rock star out in Houston, Robert Martinez. Have you guys heard of him?
Yeah.
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 So this guy had done like 16, 17 successful syndications prior to this, but he bought a Class A deal around this time, $51 million deal. And this thing went back to the bank, lost $17 million of investor capital. And I went out to interview him, and he was nice enough to do the podcast and openly talk about some of the mistakes and how this deal went south. But he was just saying like, yeah, dude, like I got aggressive with the assumptions. He said like 25% of the leases when he took over this Class A building was Airbnb like arbitrage. He said they all bailed out when things got tough. And then he said he took property management from in-house to third party, and he said the third party fucked this whole thing up. And they got behind on some payments, and the lender didn't want to work with them, and he decided to just give it back. And so, but $51 million on I think it was only like a 240 unit deal. I mean, I don't know what that is on a price per door basis, but dude.
Yeah, you got to be on your assets like a hawk, man. That's the thing. Like whether you're managing in-house or you're managing third party, you have to be on it like a hawk. And if things are not working, you got to switch gears. And if you can't if you can't switch gears quick by you running your own show internally, then you gotta at least take yourself out of your own self and say, okay, maybe I need to give it somebody else to manage. And if somebody else is managing it, then and it's not working, within a few months, you got to make a decision to get rid of them and replace them with somebody else.
Yeah. So I mean, I think a lot of people think, okay, I'm gonna use third party, and it's gonna be hands off. I'm like, dude, like you gotta be managing third party like very closely.
No, ask him.
Oh man, we have a
that
can be a longer podcast,
painful asset that we've been managing for a while.
Yeah,
it's taken a lot.
Yeah,
and you guys use third party?
We do.
Yeah.
But going back to my thought on disciplined investing, again, you have to stay in this game for the long run, right? And you need to stick to your guns, especially in an environment where, like you said, like what was his name?
Robert Martinez.
Robert Martinez. Yeah. It's like you can't be overly aggressive on your assumptions. And so a lot of the times we stuck to our guns. I mean, for the most part, we stuck very disciplined. That's one thing that was very challenging for us. We didn't transact for 18 months from our first deal when we launched our first fund. And it was tough because it almost plays like a psychological level to you. You're just like, why is everybody transacting and I'm not? Am I missing something? And so, but I stayed conservative. I said more no's than I said yeses. I said a lot of no's because the deal just did not make sense. It didn't pencil.
We said all no's.
We said all no's.
Yeah.
Well, fast forward till today, those same deals are now hitting my desk.
Oh, and the people that bought them then, now it's coming back to you
again.
And
it's unfortunate because a lot of these guys, like we know personally, they're great guys. They just, again, did not think conservatively. They were a little bit more aggressive, and now they're in a tough spot. But those deals now, I mean, there's only so much that I can say, but you can say some of these deals are in our fund.
They're what?
In our fund.
Some of those deals in our fund.
Yeah.
Yeah.
Okay. Yeah, that's good.
Yeah.
But
and you're picking these deals up for what percentage on what they traded for 3-4 years ago?
50%.
50%? Damn, that's crazy. And who's bringing you these deals? Is it the lenders?
It's I mean, lenders bring us these deals, other sponsors that we obviously work mostly with sponsors. I mean, other sponsors, operators, developers.
So give us a snapshot for the audience right now that doesn't know what Peak 15 Capital is. What do you guys do?
We were a private equity platform. We are a fund manager. We run funds, and our fund now is a GP fund. Our current fund is a GP fund. Means we go out and partner with sponsors, operators, developers in a multitude of different asset types in real estate and fund their GP economics in a deal. And then we also bring the LP economics from a stable of a few very close institutional relationships that we have to fund the LP side of the business as well. So the value for us is that we are a liquidity provider essentially in the marketplace. We're a liquidity provider for sponsors and operators. So they know that we can come in and provide, and they don't come for it. And because a lot of investors ask us like, well, why would somebody who's well established in the business come to you? Why would they need you to co-GP on a deal with them? Well, they need us to co-GP on a deal for a variety of reasons. It doesn't have to always be necessarily that they're not qualified, or it doesn't have to be that they don't have the money. It's a matter of liquidity. Like if you have $1 million to your name and that's all you got and you want to transact 3 deals, maybe you want to spread the risk. Maybe you don't want to spend, the whole full $1 million on one deal. So the reason they come to us because they want to spread their risk and they want to spread their money a little bit further. So they come to us and say, hey, listen, we have $1 million, but we don't want to spend it on this one deal. Can you guys come in for $500,000 and we'll spend $500,000 and we'll do this deal and we'll end up doing 2 deals, maybe 3 deals. So our money will go further if we partner up with you guys with Peak 15 as opposed to doing a deal on our own. Or the other scenario is that they just don't have the qualifications sometimes. So they come to us so we can lend balance sheet support and sign co-sponsor the deal, co-GP the deal. Or they come to us because they know that we have the LP connections also. So they want to bring us in. They give us a piece of the GP so just so we can bring one of our institutional LPs with us to the table. So there's 3 or 4 different reasons why people would want to partner up with us.
What asset classes outside of multifamily do you guys look at?
Well, we transacted on ever since after the 18 months that we didn't transact, we closed on a 5 asset car wash portfolio. So we did that more as a yield play, just because again, we lost so much time. We only added 1 multifamily deal into our fund. Our investors have to eat. And so we didn't see anything in multifamily, nothing that actually penciled for us. And so we started to kind of look at the car wash portfolio, and man, those things are cash cows. You cannot get a yield on multi like you would on a car wash. Now, we didn't just want to transact just on one car wash because you can't really scale that. The end game, especially now, what we started to kind of see is the institutions were starting to now allocate towards car washes. KKR, for example, they did like about a $700 million investment into Quick Quack. And I'm
Into
pretty sure
what?
Quick Quack
Quick
car
Quack
washes. I'm
They're,
sure, I don't know if
they're
you've
the
seen them,
biggest
but
car
they're,
wash franchisor in the country.
yeah, big franchise. And so when you start to see kind of Wall Street money go into some of these sectors, you want to pay attention. And so for us, the only way that you really want to scale is have not just one location like you were at multi. Of course, you want multiple units. We also want multiple locations. So we added that to the fund, and it's been yielding very, very well for us. We're doing development now. We're doing a ground up development in Dallas. We have another one in our backyard in Charlotte, which is a smaller kind of built to sell community. We closed early this summer, 970 unit multi portfolio. I'm sorry, community.
It's a big community. It's a mixed resi community in Houston.
Yeah.
We have another one that we're working on right now at the Houston, another industrial deal. So we do industrial, small bay, and then we closed a huge default loan portfolio, and that's where the biggest bump in our AUM came from that default loan portfolio, and that's where we got a lot of those assets at pretty discounted rates from their original values.
So you guys talk about smart money versus retail thinking. What does that mean?
Discipline. It's being able to have structure and think of, you have to put yourself in the mindset of how has Wall Street been in the game this long? They're in the business of being durable, building durable portfolios for their investors. So a lot of retail, especially the narrative, what we've seen, there's a lot of undisciplined investors that really are asking the wrong questions. I always see is like from the conversations that we've been having with a lot of our institutional investors, I always hear the same thing. Then usually it's they ask the same question: what is my downside? Like how can I protect my risk and not just look at the returns? And every time when I have conversations with retail investors, it's always like, well, what's my return? What am I going to get? That's really the wrong question to ask. It's great to look at a return profile, but for me, if you're going to look at it from a place of like a real investor, an institutional investor, you have to ask, how can I protect my downside? Because at the end of the day, yeah, you can target a 20% return, but what if you don't? Like what are the mechanisms that you're putting in place for you to protect your capital? Because if all you're thinking is about the returns, you might as well go gamble. This is not gambling.
What that means is a little bit more to make it more, because everything gets sold on a story. So the story of how to protect the downside is, you got to think of, first of all, who's buying that asset in 5 years or 4 years or 3 years? What's the profile of that buyer? What is that market going to look like in 5 years? Is that market contracting or is it expanding in the next 3 to 5 years? And if it's contracting, why would I really be in it now if things are going to be less in 5 years? If buyer pool is going to contract in the next 3 to 5 years, wouldn't that make it less appealing now? Why would I want to pay a premium for it now if in 5 years that same a seller, the profile of that seller is going to look at that same asset and say, I don't want to pay that cap rate that you guys are now projecting. So you got to think of all these in consideration so that you can make an informed opinion of what the buy should be today on that asset. Again, going back to what you and I were talking about with we talked about with Tony before, is that you got to look at the asset today on the buy. How is it going to perform right now, and how is it going to perform in 5 years? And then you reverse engineer it to get to today's dollar that you're going to have to pay for it.
That's really good. That's really good. So in today's environment, what makes a deal uninvestable in your standards?
I mean, a couple of different factors. We start and end with the people behind the deal.
Okay.
For us, the people behind the deal are probably more important than the deal.
Sure,
Not probably,
course,
they are
yeah.
more important than the deal, because at the end of the day, we're investing with them and in them. We're taking a bet on the sponsor and or the developer or whoever the deal manager, the GP is, that we're investing with them. So if that doesn't work, the deal's not going to work. I don't care how good the deal is. It's just not going to work.
I agree, because you could show me the best deal in the world, but if your nephew who's homeless and a drug dealer and alcoholic living on the streets is the operator, am I going to invest in that deal? I'm not going to invest in that deal,
Exactly.
right?
It will look great on paper, right?
Yeah.
But it's who's behind it that's going to actually execute.
Yeah,
And I think that's now the biggest shift that we're also seeing, is that we're underwriting the operator more than we are the deal. The deal's great. We can go ahead and stress it as much as we can. What I really want to see is who is the operator. I'm pretty sure a lot of your investors, that when you're showing them your boutique hotels, they're mainly betting on you.
Yep.
It's the jockey before the horse.
It's
right?
99%. They're betting on me.
100%.
Oh, absolutely.
Right? Because it's like, you can show me this pretty pro forma, you can show me this pretty OM, but is this guy going to execute? Right?
Mm-hmm.
Then the numbers do matter.
Yeah. And any of these decks, and I've seen so many decks from sponsors, like you can tweak underwriting and you can show whatever IRR you want it to show. Like it does not mean anything. So when I hear investors say, "Oh, this one's a 30% IRR and this one's only 17," it's like, that doesn't mean shit. It really doesn't. It's like, who are you investing into, and do you trust that person?
100%.
And what do they do? How do they perform under pressure? What do they,
And do they have the wherewithal and resources to fix problems and put out fires when fires happen? Because fires are going to fucking happen
fires
all
are
the
gonna
time.
happen.
That's right.
And
Yeah.
do they have the grit to push through those?
That's right.
100%.
That's right.
100%.
And there is one variable that have become very much an important part of our due diligence is that we have, and it's, I hate to say, it's more of a touch and feel. Like it's got to be, we have to agree on that. We like the sponsor. Like, I have to like you because I'm going to do business with you for the next 3 or 5 years. If I show up with you and you're an asshole, I don't want to do business with you.
That's number one. I always tell people that. I'm like, if you're looking to partner with people on real estate deals, like first and foremost, like, see how they talk to strangers on the street. See how they talk to servers, bartenders, because the same way they talk to strangers is the same way they're going to talk to investors, vendors, all that sort of stuff. And once you partner with them, they're a reflection of your brand. So if they're not a good human being, I'm like, I won't do it.
Oh, absolutely.
Oh, yeah.
Absolutely.
Yeah.
And, and unfortunately, we learned that lesson the hard way because we got into we disagreed on a deal. I told Francisco that I don't like the guy, and he told me he liked the deal. And I said, I don't like the dude. Like, yeah, I don't like him. He seems like an asshole. He's like, but the deal's so rich. Let's just do the deal. I'm like, he's got like the right staff. He's got the right people around him. Like, I think we'll be all right doing this deal because he's got the right company and he's got the right staff. I'm like, I know, fine. We'll do the deal. We never did the deal. We ended up getting into the deal, and then the deal fell apart, in the DD period, and we ended up losing some money on the deal. But that was a hard lesson.
It was a hard lesson. It was. And look, we learned from them, and now we're just like, no, the operator for everything. Now we have what's called the no asshole policy. I don't care how much money you have and what you're bringing to the table. If you're an asshole, like you mentioned, we're just not going to do business.
Yeah. And then, like, what's the buy box for you guys in order for you guys to do a deal? Because for me, during this entire, let's call it about 42 months now, we've been in a high rate environment. And for me, it's always been really three things. Like, one, I got to buy in a good location. You can't replace that. 2, I got to be able to buy below market value. I got to get a good going in cost basis going in. And then 3, I need a clear path to add value. And then pair those 3 with the long-term time horizon. Like all the stuff we buy is 10-year time horizon. Just because I don't know, we're buying in these really dope locations along the California coast. It's hard to find these deals. We're doing all the work to renovate these hotels. I don't want to just become a flipper. Take all the risk, renovate these assets, and then just give them back. Let's not forget the Fed has printed 80% of the money supply since 2020. And so, I believe the way to build true long-term wealth in real estate investing is to, let time do its thing, let inflation do its thing, buy in good locations. But those were the 3 rules and principles I abided to. And I still stick to those today. So curious for you guys, what are those principles that you guys are like, hey, this is our buy box?
Those are all great, and I think we're aligned there. We always want to buy in great MSAs, good locations. I think for us, really, we have a very healthy pipeline. It's not so much of where do we have to be, but it's the story behind a specific deal. I feel we've heard so much about the value add deals. Of hey, you want to throw some lipstick on a pig, and you're gonna go and be able to bump rents by like $200, and all of a sudden, like that used to be the play, but now you can't really. It's almost like trying to squeeze blood out of like a rock or something. You know what I mean? You can't really squeeze much out of it if you've already done a renovation 5 years ago. That's not a play. I need a story. Is there distress? Is there a partnership issue? Like, what is the story as to why I'm getting this deal? And for us, as we mentioned, like the distress loan portfolios, we prefer more of that story. And still, of course, in good locations, strong MSAs where we have strong fundamentals. I need strong fundamentals, economic fundamentals, which is growing population, growing jobs. Like I need all of those because at the end of the day, if there's no demand in a certain area, then I'm not really going to look at it. And I pay attention to a lot of the supply as well, because supply, I think most folks forget about the amount of supply in a certain market. So if, again, you can talk about location all day, but if that location is oversupplied,
Yeah.
you're in trouble.
Supply constraint areas
Yeah.
is big.
100%.
A lot of people were hyping up, Orlando, Phoenix, even Nashville. And we see what's happening in Phoenix right now. Grant Cardone's been on his podcast a few times, and he always says if there's cranes in the air, beware. And so you got to be careful of the oversupply. One thing I do love about California, a lot of people hate on California, but it's very hard to build here. And so there's a lot of barriers to entry. It could take 4 years to get permitting and entitlement. And so I kind of like that. You know what I mean? I like the bureaucracy, red tape. I understand the market here, and it's impossible to build here.
Yeah.
And
well,
you-
bureaucracy,
and you-
red tape create barriers to
Yeah.
entries.
Yeah.
So
So I like that here. Now, yeah, for you guys, are you guys looking at that as well? Like new supply coming on the market?
well, absolutely. Yeah. I mean, if there's a ton of new supply coming on the market, then you got to adjust what your expectations of rent growth is going to be. So if I'm buying an asset right now that is by itself now, but there's construction starts in the area for 3 other assets, I know I'm not going to be able to maintain that rent growth for the next 5 years, 6 years.
No, it's going to matter because, I mean, you might end up in a concession war, right? So, and it does matter. Here, I'll even talk about small bay, right?
What's small pay?
Small bay industrial. So Houston had about a 75 million square feet of supply injected into that market in big box industrial. So chasing after like the Amazons for logistics distribution. But you have to understand that markets are built on small businesses. So you have a lot of these smaller business owners that don't need a 100,000 square foot building. They need like that 30,000 or 10,000 or 12,000. So
Or
small
5,
bay.
or
Yeah.
5,000.
And it's like the HVAC guys, the plumbers, the landscaping guys. And especially today in social media, I mean, businesses are blowing up almost overnight. And so as they're growing their business, where are they going to go? There's not enough small bay because everybody is trying to cater to these big box kind of tenants, right? So you have a low supply but a high demand in the small bay area because these small business owners need a place to kind of park their business. And so that's where we saw the opportunity is like, look, there's so much demand and location matters in small bay, but there needs to be some sort of space to kind of have these small businesses continue to thrive, continue to grow as they scale. So
Yeah.
And by the way, that's symptomatic across the nation, not just germane to Houston.
yeah,
Mhm.
even in Charlotte.
This small bay surge is happening across the nation. In places like Charlotte, North Carolina, places like Orlando, places like Dallas, places like Chicago, places like all over the place, even here in California. So there's not enough supply of these, especially newer small bays, as opposed to older, really older small bays. And a lot of the newer small bays, they have higher ceiling capacity, just pressure. Have more adjustments to them. Older small bays are not that way. So a lot of the business owners prefer much newer small bays that are built in 1919 or 1920 and newer, because they have that really high ceilings that they can afford to either bring in trucks or do different types of businesses inside
Yeah.
those.
Well,
So-
this is a perfect example of real estate and the asset right here that we're in this with the podcast. This is a 140-year-old building. You can see the natural brick behind you, the arches and all that. This thing was an industrial building back in the day. They would manufacture a product here, goods and products, and they would ship them down to the train tracks behind us, and then also load them up on the ships, and then they would export them out. But 140 years later, this building is still bringing in income in the form of rent. They repurpose it to office space now, and still producing income 140 years later. And so, I think it goes to show investing in real estate and buying assets in supply constrained areas, where there's not a lot of risk of building in areas like this. It's even if you can't use that asset to bring in money and what it was initially built for, there's always some sort of purpose. You know what I mean?
Oh yeah,
Yeah.
for sure.
So question for you guys. What is the biggest play right now in commercial real estate that nobody is talking about?
I mean, I think I definitely think small bay industrial is definitely at the top of my list. One that definitely meets one of the top 10s of what's going to be that's going to be very accretive for investors. I think anything in the sort of the medical space, that's whether it's standalone emergency room, standalone urgent care, something like that, that's going to be hot. Anything in the sort of the quick medical treatment type of spas or aesthetic treatments or something like that would be rental. That's going to be pretty hot as well. I mean,
I'm going to say something different.
Oh,
that's fine.
Let's
That's
go,
fine.
Francis.
That's
So
how we work well together.
give
Because
us
he
some
thinks
game,
different.
bro.
I think
Give us
different.
some game, dog.
Yeah, so I think everybody is chasing deals and they really should be chasing relationships. I think that's going to be the biggest key in 2026. And the reason I say that is, and especially some of the conversations that I have, everybody's trying to figure out, how can I get these deals? Where's the next big thing? Where's the next market? A lot of our deals have been because of how well we've been fostering our relationships. And instead of always chasing deals, I would say in 2026, if you did a good enough job building your relationships in 2025, you shouldn't be worried about 2026. 2026, you will, if you did your job right by really building those relationships, staying in front of them, trying to at least figure out how much value you can bring to those relationships, they're going to bring you the deals. And that's really where we were able to transact so much during the summer, and why we grew our AUM over 500 million was for the fact that we built great and solid relationships. There wasn't a downtime really when we were quote unquote transacting or not transacting. We were still in the market, and that doesn't mean that we're doing deals. It means that we're still fostering our relationships. Yeah.
Yeah, I agree, because I mean, we can talk about the hot top, sectors or asset types that are going to be in the marketplace. But look, at the end of the day, it doesn't matter if you have those right relationships, and if an amazing deal comes to you, are you going to say no? Are you going to say it doesn't really meet my buy box because it's making 30, 40% IRR, but it's not in my buy box? I'm not going to buy it. Yeah, of course you're going to buy it, because it's an amazing deal and you're going to transact. But it's only going to come to you because of those relationships that Francisco talked about. You can have a certain buy box of assets that are going to be really appealing in the next 1, 2, 3, 4, 5 years. And those asset types that I mentioned earlier, like the medical and the small bay and a lot of the industrial data warehouses are going to be huge. I also believe in that as well. But again, it's a matter of the opportunities that come to you. That's really what's going to differentiate it. And the opportunities that come to you may not look like those. but may look like something different, but they are going to be very, very accretive to you because of those relationships that Francisco's talking about.
Yeah. I like that you said that, Francisco. I can echo that. Couple of the best deals we bought came through a personal relationship. Because we're out there, take care of all the people we work with, our vendors, our lenders. And I truly believe that if you treat people well, people like you, they're going to bring you opportunities, And I always say, like, you going out talking to brokers, lenders, and all that. It's like, dude, like these lenders are funding, they're your biggest capital partner. They're putting up the majority of the money. So it's like, why wouldn't you become their best friend? When deals go bad, these folks are the first ones to know about it. And like, if they like you, they're going to bring you these opportunities. And so I totally echo that. Out of curiosity, what are you guys seeing today when you're underwriting? Francisco, I know you do a lot of the underwriting. What are you guys seeing today in terms of like seller financing opportunities? Is that something that's happening? Assuming loans, is that happening? What are you guys seeing out there in the debt markets in
You
terms
know
of that?
what? Early, like I want to say like 2023, we did see a lot more assumable debt. Now it's just more buying distress notes. Going back to the narrative of what we're now seeing today is just a byproduct of all the undisciplined investing that happened over the last few years. Seller carry is not as popular, to be honest with you, in commercial real estate. As far as in our world, I know there are some guys kind of like, I know Pace Morbey, you've had him on here, and he's really big on doing a lot of like the seller carries and all that. But we don't really see a whole lot of opportunity like that in our space, to be honest with you.
You'll see that sometimes in mom and pop sales every now and then. You smaller assets. Assets have been in kind of a mom and pop operation, and they don't mind holding a note on it. You'll see, but that's very, very far and few in between. Very far and few in between. Because in this market, if you can sell, why would you want to just take the note back? You don't want to sell and get liquidity. The name of the game is liquidity.
Yeah. Are you guys seeing a lot of deals? Like, I'm curious the breakdown. Deals that go broker listed in today's environment, maybe go through one of these auctions like 10X through CoStar LoopNet, or just transacted off market.
We see some off market deals. I mean, certainly, and not a lot of true off market deals, because these, let's face it, when brokers come bring you a deal and they say it's off market, it's not really off market. It may not be hitting 1,000 people, but it's certainly hitting 100 people. So that's kind of semi off market. But I mean, the true off market deals are the ones that are coming from lenders,
relationships.
and relationships. The ones that are they being brought to you directly from the sellers of those deals, from the lenders who are telling you, hey, listen, we have this portfolio of assets that we want to get rid of. Would you be interested in buying it? Those are true off market deals. If they're coming from a broker, they're likely not off market.
Mm-hmm.
I guess they call it quasi off market because they're not doing a full marketing kind of blast out. But I mean, look, they're most likely, as John mentioned, they're still hitting quite the handful, and it's whoever comes first to the table. So true off market is really kind of coming from our relationships. Again, this big portfolio that we just closed, that was a true off market lender to sponsor. We knew the relationship, they came to us, and that's why we play so well when we have an edge in the market. Is look, at some point you're going to hit a ceiling. You want to continue to scale. How do you do that? You find partners, and where, look, the deal's big enough where we can all eat. It's like we can all split the pie. So they're going to come to us, and we're able to kind of participate through our fund. That all came through a relationship. So at the end of the day, it's like that's really where I'm going to see the opportunities, and I think a lot of folks are going to see the opportunities in 2026. Is really how good you've been doing your homework, or at least how good you've been building those relationships.
Yeah. When you're underwriting, you're looking at, capital stacks and all that sort of stuff. Like with these discounts that you're seeing in the marketplace right now, are these groups getting new debt? Are you guys getting new debt on these assets? And if so, like what is the LTV, and what does the capital stack kind of look like?
Yeah, in some cases, the debt, like for instance, like the lenders, they're getting creative. Like, look, don't get me wrong, they're taking off, they're shaving off a little bit off the unpaid principal balance. They're taking a small hit, but they're making it at the back end. So they might give it to you for a discount up front, but you have to get creative. And lenders, they're not going to take a big hit. They're always going to find ways like how can we either make a little bit more, or at least break even.
When
And
you
that's
say lenders are making it up on the back end, what do you mean by that?
they're participating on the profits at the end.
Uh,
Yeah,
Yeah.
that's how they're making those
So
deals
they're
happen.
like, okay, we'll give this to you at 70 cents on the dollar. However, there has to be some sort of a profit split. Either it's going to be 80, 20, 90, 10, but that would have to make sense for them economically that, hey, we're going to be made whole at the back end.
Or as
So we're
close
not,
to it as possible.
yeah,
You know,
it
'cause
might
they,
look like a loss now, but we're going to make up for it once they sell everything off.
because they got to go back and sell it to their own investors. I mean, you know, everybody got somebody to answer to. You know, they have either a board or they have investors that got to answer. They got to justify why they're selling these assets at, you know,
At a loss.
at
You think
80,
banks are going to
70
take
cents on the dollar.
You think banks are going to take billions of dollars of losses? Like they're not going to do that. They can't do that. They can't afford it. So this is the one thing that I love about real estate is you can get creative in any way on how you can structure the capital stack. And so for banks, yes, do they have to say to the investors and report, hey, we're going to take a loss this year, but then hey, we're going to make it back up in some way, and it's always going to be through a profit split, whether that's through a waterfall on certain hurdles. And look, I mean, that's how someone like Starwood Capital kind of like built their business, right? It's like they partnered with the government, gave them 0% financing on anything they wanted to buy on multi. It's like that's a no-brainer. And so for them, it's like, yeah, the government made a deal with them. We'll give you, it's going to be a waterfall, 80-20 or 60-40. Any operator would want to take that.
so what are you guys forecasting for 26? I know you said, hey, 100 basis points of cuts, potentially more. You know, if that plays out, do you guys foresee, you know, an ease up in these deals that are going bad? Like what do you see as we go into 26 and 27?
I made a post on this, and I'll let you chime in on this, John, as well. I made a post on this. It's like I feel like we're in a thawing period. I think anytime when we get like a cut, everyone thinks like, oh great, now we're gonna start to see all like a flood of deals. That's not the case. It's still gonna be slow. I think now movement is real, 3 consecutive cuts. And by a thawing period of what I mean by that is like the capital markets has been almost nearly frozen for some time. Nobody's transacting. There's a ton of dry powder. Nobody's deploying because everyone's waiting for this huge opportunity.
But
So
on the flip side, I'll say this, like I agree with you, but the everyday American, a lot of these folks, liquidity has never been so low before. Credit cards, individual credit card debt's never been so high before. And if you think about it, why is that? The way that most Americans re-up on liquidity is by refinancing their primary home that they live in. And that's how the middle class re's up on liquidity. And so even if you're like a high income earning doctor or attorney, right, you still have probably kids in private school. You probably have expensive car payments. You probably have an expensive mortgage. And those folks still need to re-up on liquidity by refinancing their home. No one's been able to refinance for 4 years now. And so I do agree that, like, you know, on the high end, the wealthy, they have some dry powder. But I still think that people that make between 100 grand and $400,000, let's call it, a year, a lot of those folks, liquidity has never been as tight as it is today.
Absolutely. Absolutely. I completely agree. I mean, I think the past 4 years have created such a seismic shift in wealth creation and wealth transfer in the United States. To your point about people using their home as liquidity providers. I mean, right now, in the past 4 or 5 years have caused a generation to rethink home ownership entirely. You have more people than ever now, a generation of young folks living with their parents, living with their significant others, living with their families, as opposed to buying their own homes because they don't see the value of buying their own homes. It's too expensive, or they just don't want to be tied down to an expensive mortgage. So those transactions are not occurring as they used to be 4 or 5 years ago. So home ownership and home transactions in general, residential, I'm talking about residential homes, single family homes, are at an all-time low because that's been happening for the past 3 or 4 years, and now it's at an all-time high. You know, credit cards, as you mentioned, is at an all-time high. You know, consumer debt, and it's not being refinanced. So the whole mentality of sort of wealth and wealth transfers and the use of wealth in this country have changed for a while, and I don't think it's going to be readjusted again. It's going to take us probably another 5 to 10 years to readjust that. You know, it doesn't matter what happens next year. You know, it's going to the ramification of what have occurred in the past 4 or 5 years, it's gonna wash out of our system just in the next 1 or 2 years, just because of 100 or 200 base cuts. It's gonna take another 5 to 10 years to change what have occurred in the past 4 or 5 years.
Will we see 3% rates again?
I don't.
My crystal ball is hazy.
I don't know. I mean, we may. It depends how next year goes. If next year does not go as smoothly as we think it's going to go, then there might be another year of major drastic cuts, and that might get us in that 3% range. But it ain't gonna be next year. But there's a possibility that if things don't improve next year, we may see that in 2027. I don't know, or close to it. We may be dipping below 4. Let's put it that way. I don't know about 3. But we may be dipping below 4.
Yeah. If someone's listening to this right now and they're like, man, I want to get into, syndication. I want to raise money to buy apartments or whatever asset class it might be. What's one piece of advice that you would give them right now?
I would say start in property management.
Start in property management?
Yeah.
Why is that?
I would. Too many people get caught up in wanting to polish the vehicle, but they don't want to open up the hood and seeing what's under there. And I think you'll learn a lot about property management and how to actually manage and see what goes on the day-to-day operations before you get into a syndication. You just want it. It's not all about living on a pro forma. It's not all about underwriting and, hey, I want to buy this property because it's kicking out good returns. Figure out how you can actually operate this property. How do you deal with tenants? What are evictions looking like? What are work orders? Like, nobody really talks about these things. And if I had to start again, I would absolutely start in property management, because you will learn so much in the trenches in property management before you would actually get into investing.
That's really good. I can attest to that, because we're vertically integrated, operating boutique hotels, and out of all the arms of my business, that's probably the arm of the business I like the least. It's just putting out fires, and luckily I got an amazing team, but through a lot of, just in the trenches, grinding, putting out fires left and right, we've figured out a way to get better and better and better with the operations. And now looking at other deals, I'm like, hey, I know based on how we operate our stuff, like how we can operate these other deals, and it's always interesting to see how other people are operating, what their numbers kind of look like.
Yeah,
it gives you perspective. It gives you perspective.
100%.
That's the thing. And that's the thing that gives
Yeah.
you. It gives you perspective when you start managing your own properties, for
Yes.
sure. Another place to start, a good place to start for folks coming into the business, is on the analysis side. So meaning that if they can get into a brokerage shop and start doing some analysis on deals, and as much as they can do that, that's going to give them a good edge as well, because underwriting is name of the game. I mean, underwriting is king in this industry. So that's another way for them to sort of get into that. And then finally, they can get into our educational platform that we're launching next year.
Good plug.
I love it. Johnny, Azar, Francisco, Herrera, do appreciate you guys coming on, man. Can't wait to celebrate with you guys this weekend. How can the folks get in touch with you if they want to learn more with everything you guys are doing with Peak 15 Cap, also your educational product?
Yeah. We're launching a new educational platform next year, and it's not a course. It's not just there will be a course, but it's not just a course. It's not a mastermind. It's a truly institutional grade educational platform. All asset types. It's not just multifamily, but we do have a big concentration on multifamily, but that will be launched, and it will be an ecosystem for learning of the commercial real estate business. And we're going to be partnering up with some colleges, and we're going to be giving away some scholarships. But it's going to be very robust, and we're looking forward to launching that next year.
Yeah, you can also find us on our website, peak15cap.com, or follow us on Instagram. I'm peak15cap, or I'm invest with Francisco on Instagram.
If someone is listening to this wondering, like, hey, they operate, what type of person should be reaching out to you guys to partner with Peak 15?
If they're an operator, any operator who's looking for a partner, liquidity provider, if they want a co-GP or looking for LP liquidity, GP liquidity, reach out to us. Let us know. Let's have a conversation. Like Francisco said, peak15cap.com. I'm on LinkedIn. I'm very active on LinkedIn, so I love it.
I love it. He is Johnny Azar, and we got my man Francisco Herrera. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys on the next one. Peace.